Welcome to Kuwaiti Dinar Analysts, where we explain currencies, oil markets, and global economic power without hype, fear, or speculation. Oil prices rise. Headlines explode. Markets react. But one important question is often misunderstood. If oil prices stay high, which currencies actually benefit the most? Because higher oil prices do not help everyone equally. Today, we break this down step by step. This is an educational analysis, not financial advice. Let's start with the basic assumption most people make. Oil prices rise. Oil-producing countries earn more, and their currencies strengthen. It seems logical, right? More money flowing in should mean a stronger currency. But the reality is far more complex. A country's currency strength doesn't just depend on its revenue, but on how that revenue is managed. The truth is, some currencies benefit strongly from high oil prices. Others barely move. And in some surprising cases, they even weaken. The idea that oil income automatically translates to currency strength is a common oversimplification. And today, we're going to explore why. To truly understand the winners and losers, we have to look beyond the headlines and dive into the mechanics of how money, oil, and policy interact on a global scale. This journey will take us through different economic models, fiscal strategies, and the real-world outcomes that shape the value of a nation's money. So, how exactly do high oil prices affect a country's currency? When oil prices stay high for a sustained period, oil-exporting nations start earning significantly more foreign currency, usually US dollars. This influx of cash improves their trade balance, as exports are now worth much more than imports. At the same time, government revenues soar because many governments either own oil companies or tax them heavily. This extra income can be used to support the currency in several ways. It can boost foreign exchange reserves, providing a buffer against economic shocks. It can also increase investor confidence as the country appears fiscally stronger and more stable. But here is the critical point. This positive cycle only works if the country has the right foundations in place. We're talking about strong institutions, controlled inflation, and responsible fiscal policy. Without these, the oil boom can quickly turn into a curse. Oil revenue alone is not enough. The infrastructure to manage that wealth effectively is what truly determines whether a currency strengthens or stumbles. Now, let's talk about the biggest winners, the disciplined oil exporters. The currencies that benefit the most from high oil prices almost always belong to countries with a few key characteristics. First, they have budget discipline. This means they don't spend every dollar that comes in during the good times. Second, they have large financial reserves, often built up over decades. This acts as a shock absorber. Third, they maintain stable monetary systems and have a long-term vision for their economy. These countries understand that oil booms don't last forever. So, what do? They save a significant portion of their oil revenue during the booms, often in sovereign wealth funds. They avoid the temptation to print excessive amounts of money, which would devalue their currency. And they work hard to protect their currency's credibility on the world stage. For these nations, high oil prices don't just boost income. They reinforce global confidence in their ability to manage their economy responsibly. It's this combination of wealth and wisdom that allows their currencies to become stronger and more resilient, not just temporarily inflated. On the flip side, why do some oil-exporting countries fail to benefit, or even struggle, during an oil boom? The answer often lies in mismanagement. A sudden flood of oil money, without the right policies, can be destructive. One of the biggest culprits is high inflation. If a government spends its new oil wealth too quickly and recklessly, it injects massive amounts of cash into the local economy. This can lead to a surge in prices for everything from food to housing. Another issue is heavy government subsidies. To keep the population happy, some governments use oil money to subsidize fuel, food, and electricity. While well-intentioned, this can become incredibly expensive and unsustainable. At the same time, as people feel richer, they tend to buy more imported goods, causing imports to surge and putting downward pressure on the currency. When oil income is spent too fast without any discipline, it creates a cycle of inflation and rising imports that can actually weaken the currency over time. The oil revenue, in this case, becomes a source of economic instability rather than strength. The type of exchange rate system a country uses also plays a crucial role. Broadly speaking, there are three main types: pegged, basket-based, and freely floating. In a pegged system, a country fixes its currency's value to another currency, usually the US dollar. For these countries, the primary goal is stability. The extra income from high oil prices is used to maintain and defend that peg, ensuring the exchange rate remains predictable. Then you have freely floating currencies, where the value is determined by market supply and demand. In these systems, high oil prices can cause significant volatility. A sudden increase in oil revenue can cause the currency to appreciate rapidly, which might sound good, but it can also hurt other export sectors of the economy. A strong system, whether pegged or floating, will have policies in place to manage these effects and reduce volatility. A weak system, however, will see this volatility amplified, leading to economic uncertainty and instability. The choice of exchange rate regime is a fundamental part of how a country translates oil wealth into currency strength. So, where does the Kuwaiti dinar fit into this picture? Kuwait is a fascinating and unique case. The dinar consistently benefits from high oil prices, but it does so with remarkable stability. This is thanks to a combination of factors. First, of course, are the vast oil exports that form the backbone of the economy. Second, Kuwait has incredibly strong financial reserves, built up over many decades of prudent saving. Third, and this is key, the Kuwaiti dinar is not pegged to the US dollar alone. Instead, it's linked to a basket of currencies. This basket system provides more stability and insulates the dinar from the volatility of any single currency. Finally, Kuwait is known for its conservative monetary policy. When oil prices are high, the increased revenue strengthens the country's reserves and improves its fiscal balance. This reinforces confidence in the dinar. You won't see the Kuwaiti dinar spiking suddenly on the news of higher oil prices. Instead, it remains steady and predictable. And in the world of currencies, that kind of stability is its greatest strength. Now, let's broaden our view to the global economy. The dynamic between oil importers and exporters creates a major divergence during periods of high oil prices. For oil importing countries, like most of Europe, Japan, and India, sustained high oil prices are a major economic headwind. They have to spend more of their foreign currency to buy the same amount of oil. This increases their import costs, which can widen their trade deficits. It also fuels domestic inflation, as higher energy costs ripple through the entire economy, from transportation to manufacturing. As a result, the currencies of major oil-importing nations often weaken under the pressure of a prolonged oil boom. This creates a clear divergence in the currency markets. The currencies of disciplined exporters tend to gain stability or strength, while those of importers face downward pressure. This gap tends to widen the longer oil prices remain elevated, shifting economic power and wealth from oil consumers to oil producers. This brings us to the role of gold and national reserves. High oil prices give exporting countries a powerful tool to strengthen their economies for the long term. With the surge in revenue, these nations can do more than just pay their bills. They have the opportunity to significantly increase their foreign currency reserves, reduce their national debt, and accumulate strategic assets like gold. These actions have a profound effect on their financial standing. By strengthening their balance sheets, they become less vulnerable to external shocks and financial crises. This, in turn, boosts international confidence in their currency. A currency backed by deep reserves and a healthy amount of gold is seen as more reliable and resilient, especially during times of global uncertainty. So, it's not just about earning more money, It's about using that money to build a financial fortress that supports the currency as value for years to come. So, after all this analysis, what's the final verdict? Which currencies benefit the most when oil prices stay high? The answer is clear. It's not the loudest currencies or the ones that jump the fastest. It's the most disciplined ones. The biggest winners are the currencies backed by stable government policy, a long-term strategic vision, and massive financial reserves. These countries understand that oil is a finite resource and that booms are temporary. They use the good times to prepare for the future, saving and investing their wealth wisely. Oil provides a massive economic advantage, but it's the management of that advantage that ultimately decides the outcome. A country can have all the oil in the world, but without discipline, its currency may never truly benefit. True strength is built on a foundation of prudence and foresight. In global finance, resources create opportunity, but it is discipline that creates strength. If you want calm, factual analysis on currencies and oil markets, free from the usual hype and panic, then subscribe to Kuwaiti Dinar Analysts. Because strong currencies are built quietly, not loudly. Thank you for watching.